Hey, what's going on, traders? This is Chris at Verlo Trading. Welcome to today's video. In this video, I'm going to talk to you guys about trading the Fed and trading economic data announcements, but mostly centered around the Fed. So this week here, I'm filming this, it is December 15th, 2022. And we're going to go over some live trades that I took trading the US treasuries market. And I want to show you the trades from start to finish. And I also want to talk to you about trading the Fed and do I think beginners should be trading the Fed, basically. So my whole experience around it. So if you're new to trading, if you're intermediate or experienced, I think that this video can inspire traders to become better at what they are doing. And that's pretty much the purpose of this content. So if you guys enjoy it, you can press the like button. And if you want to support these videos, you can check out some of the links in the description. The first link in particular, if you click on it, it will support the YouTube channel directly. And you guys understand that it takes a long time to make these videos and I don't really get paid to make them. So that's it. Let's get on with this. So we're going to look at some trades from the FOMC, and I want to talk to you guys about trading the FOMC. Basically, so since I've been trading since 2018, I've seen my fair share of Fed meetings thus far and kind of what the market does. I want to talk to you about kind of what I think about all this. First of all, when I'm trading the Fed or when I'm trading in general, I don't look at news headlines. I don't look at the actual numbers that are coming out because those numbers have really no benefit to my trading. My trading is purely based on technicals, order flow, and I have a strong understanding of the variables that come together that give me my trading advantage for the trades that I look for. And none of that really has to do with the actual economic data itself that is coming out. The fact that the economic data is there, that's the catalyst for the market to move. And then I use my other tools and methods to kind of trade around the volatility that has been caused by the new data that has come out. So I don't really even look at the actual number. Honestly, I didn't know if the Fed increased them by 50 basis points, 75 or 25 basis points. I really couldn't care less. I'm going to look at it after, obviously. But when it comes to the day trading the Fed, it has nothing to do with how much they're actually going to raise or lower it. It has everything to do with the volatility that's being caused by that number that's coming out. So that's more of what I'm focused on. So back a few years ago when I was trading NASDAQ futures mostly, sometimes I would even have the press conference on and I'd be listening to them talk while I was trading. And I never really got any benefit from that. It was just totally a distraction. So I learned from that basically, and I don't really do that anymore. I just have my trading software running, which is Sierra Chart. I just run that alone. And I have process priority designated to the primary trading instance of the software because I do need to be quite fast sometimes for executing orders. The next thing would be, would I trade the Fed if I was a beginner? To be honest, I wouldn't. If you were trading with real money and you're still just getting started and you've never traded a Fed meeting before, do not trade it with real money. I mean, because the Fed meeting is when there's tends to be a lot of volatility. Right on the kind of announcement and then during the press conference. And you can see a lot of these sort of outsized moves and you really just don't know what to predict. All you can do is you have to have good experience managing your risk and really understand, the context that makes up your trades and your trading decisions and your plans. If you don't have a good understanding of that, meaning you're pretty much a beginner or you don't fully understand your method, then I don't think you should be at all trading during the Fed because in the case that you're just not well set up with your stuff, you get one move against you and that can pretty much wipe you out. I mean, you never know, right? You're leaving the door open for that stuff to happen and you really just don't want that. So if I was running a firm, if I was the head of the firm, risk management, and I had some guys come in and they were new and they wanted to trade the Fed, I would force them to be on demo, not even one lots, on micros, simply because of the fact that you're brand new and you don't even understand how a trading platform works. You don't even understand what a client side stop condition is. You don't even understand what an offer is potentially. So basically, I would not allow anybody to trade the Fed if they were a beginner. But that being said, the Fed and other economic data that comes out, basically economic data releases, is a trading session that, depending on the market you trade, should be studied in great detail afterwards because these types of sessions tend to offer good volatility and good movement in the market. Now, they don't always. Sometimes the action is absolute trash. That's why there's other context that goes into it too. I'll kind of give you an example. So for example, this week, we had the CPI number on Tuesday, we had the Fed on Wednesday, and we had some other economic data here on Thursday in the morning, 8:30 in the morning. So all week was pretty busy and packed with volatility. What normally happens, at least in the bond market, from what I've observed, is the market goes from these periods of volatility expansion very quickly, and then it slowly contracts to the point where there's just no more opportunity anymore, and you simply have to just get away from it when it's doing that. And when there's no volatility, no more inefficiencies, all of them have been captured, and no more traders are playing the game anymore, you get out of that. And you have to be able to get out, while you're ahead, kind of. And that's kind of, I did that this week, and I'm pretty happy about my performance this week. And I'm going to accredit it to a number of things, not just the fact that I've been trading for a while and I know my strategy well enough. There's other things involved with that too, about how I have developed in managing myself and learning about different meditation techniques that help me to stay on top of my emotions and sort of the reactions that I have to taking trades and viewing the market in real time. That's all very important stuff. So for example, with this week, we had Monday was pretty much, I don't even think I traded Monday. And then Tuesday, bang, 8:29 in the morning, they started buying this, and then it slammed up at 8:30 after that. If you do look at generally this price action, you can see that the market really traded until about 10:30, and then the volatility tapered off. You can see here, then we have about, 5 bars in a row here, 15-minute rotations, where it's just pretty much in a trading range, in a very small trading range. And then it tapers off for the rest of the session until the next day where we have the Fed. So as a trader, you have to understand this idea, this concept of volatility expansion and volatility contraction. It's very important because it allows you to basically get a better idea of when you need to be pushing the gas pedal and when you need to be slamming on the brakes and getting the fuck out of there, basically. And of course, by no means is this a perfect example, but I'm just kind of giving you a bit of context. So there might be situations where the market has been very busy going into a Fed meeting. Let's say we've been busy Monday and Tuesday. For whatever reason, there was a lot of imbalances and traders had to come in and hedge their book. Maybe they forgot about the Fed meeting, and then just some guy came in and they had to buy everything or sell everything. And all of a sudden we have a lot of volatility 1 day or 2 days before the Fed. And normally that's not common, but I guess it could happen too. So what that could result in is volatility before the Fed, and the market being a giving market before the Fed. And then when the actual Fed hits, maybe it'll be a non-event. You see what I mean? So you have to think about the context going into these economic data events, and also coming out of them as well. Depending on the market's reaction to the event, that's going to set up additional context for after it's done. The next thing about trading the Fed is that I think a lot of people get very emotionally kind of swept into these types of things, because you see a lot on the television and on the internet about various programs that talk about, oh, the Fed is doing this, watch out for this. And there's just so much noise out there. And as an experienced trader, in my opinion, I think you need to learn how to tune pretty much most of all of that out. And really just focus on what gives you your edge and your strategy and your execution of your edge when the time comes, because the train is only going to be there for a very short amount of time before it's gone, and you need to be there to execute your edge flawlessly every single time. So like I said, I wouldn't allow anybody to trade the Fed with my money unless they were highly experienced trading the Fed and they had some stats to back that up. So let's show some trades now and talk about trading the Fed. So we're going to talk about trading the bond market. The bond market is a very interesting market. We're talking about trading US Treasury futures here. Now, most of you guys probably have experience looking at the NASDAQ futures, the S&P 500 futures, or maybe even crude oil. And looking at those markets are, I would say, more consistently volatile than US Treasuries are. And that may not be always a good thing either, because there's a such thing as good volatility and untradable volatility. So for example, if you guys watched the Fed yesterday, let's look at this recording here. Now we're going to go basically to right when the meeting hits, or a couple of seconds before the meeting hits. And I'm going to show you a couple things on my screen to start. So here we have the depth of market, and you can see that the liquidity has thinned up quite considerably. If we look before the meeting here, I want to bring your attention to a number at the bottom of my screen here. You can see where it says depth 55. What that is a measure of the liquidity, or basically the number of orders at every single price. It's an average of the number of orders at every single price, basically. And it's actually a percentage of that average. It's not the entire number. It's about 25% of it anyways. It's a magic number that I use for my system. 52 in this case, what it means is that the average bid or offer size right now in the market is about 200 per price, because this 52 represents about 25% of that, okay? So it doesn't really matter what the percentage is, but all this is doing is basically giving me a reading of what the liquidity is in the market. And this is helpful for me. And I developed this in Sierra chart because it's something that I wanted to see, which is basically when the liquidity in the market is becoming thicker and thinner and how it's changing. And it's been very interesting to watch this, especially before economic data announcements. So what you'll notice here approaching the Fed, say a couple minutes before the Fed, now we're at 52, I'll forward it, now it's slowly decreasing, 48, 46, 44, and all of a sudden now we're at 22. What it means is that now the average bid and offer for all these prices here is about maybe 90 to 100 at each price. And this is going into the Fed. So it makes sense because market makers are pulling the liquidity out before an uncertain event. And you'll see how even during the session after the actual announcement, the liquidity still didn't come back. And there were moments where it did come back very briefly and then it went away again. And it was kind of interesting to see that. And you wouldn't have seen that unless you kind of have laser eyes and you can read all these bids and offers like, really fast. But, as a human being, you kind of want shortcuts to be able to do math, and that's what technology can provide you, which is great. So the announcement hit, it slammed down, and the liquidity is not really quite there. And we're gonna basically fast forward to the first trade of yesterday, which was a momentum-based trade. And I want to show you the market context behind this trade as well, because there was some context. Actually, we were playing on a reclaim of a daily chart supply and demand zone, which I'm going to get on the chart now to show you. So this is a chart for the 10-year futures. And basically, this is the level that I was looking at, which is 114 and 12. And it is a supply zone that was created on this day right here. Basically, as soon as this bar closed below that low, that gave my system a new level to be watching for, okay? Now, these levels are interesting, and I have certain principles that I apply around how I trade them from a short-term standpoint. The concept is basically that when the market hits those levels and reclaims them, you're probably going to see some institutions that come in to hedge and throw on some orders. Either they're putting on a hedge or taking off a hedge, but either way, there's an imbalance that's happening and the market is going to move at least a few ticks. So you take it for momentum entry, and that's what this trade was. And I'll show you the execution of this trade. So that's the level I was watching first on the 10-year. And also at the same time, there was a level here on the 5-year note, which was this 675 here, and there wasn't anything else in this area other than that 675, and that came from this date right here, which was December 9th. And other than that, there was additional context on the 30-year because in this moment it was trading below 130 and 31, which is also a daily chart zone that I was keeping an eye on. Okay. So let's go to the trade now and we'll look at how it was executed, and it's a momentum-based entry. So this is going to be after the announcement hit. Okay, so now we're currently 2:05 p.m. Eastern time, so 5 minutes after the announcement of the interest rate hike. And I'm looking at the market and I'm referencing a chart that I had in the background there, and also I'm referencing my charts here. And remember, the reclaim zone is down here at 12 to 11 and a half. So what we're going to do is we're going to watch how the market trades down there the first time, and we're going to watch this play out, and I'm going to try to point out to you any nuances I was seeing. So the market is slamming down. We're seeing a lot of orders. You can see it slammed down there on the bids on the 5-year. Now look over here on this DOM here. We were trading 62 contracts at 12. That's what we've currently traded. Last traded price there, 62 on the bid at 12. Okay. And then it trades back on the offer at 12 and a half. One more goes through, but we still haven't traded on the offer at 12. Remember, the price of the reclaim is basically right here, 12 and 11 and a half, right next to each other. 11 and a half is a 15-minute zone and 12 is a daily chart zone, and they're both pretty much in the same zone. So whenever you have two levels that are kind of right next to each other, you basically use it as a range rather than one strict price, because you have to account for potentially some variance and some inefficiency in that area. So the market created a complete auction down at 12. A complete auction is when only one side of the market trades. So when the market is going down and there's only bid volume at a price, That is like a market order flow term called a complete auction. Now, it doesn't necessarily mean anything, but it can act as a nuance. So what we saw here is a complete auction at 12. Then they bid it up immediately, took the offer at 12.5, and it's going bid a couple of ticks higher now at 13. So I'm seeing this, and I find that interesting because we have a complete down there. And I basically want to see how it continues to trade. So now right here at this moment, now we have the bid. Again, they slammed the bid down. We have 500 that printed on the bid, and we have some that printed on the offer. So we're no longer completed at 12. Now we're completed at 11.5 because we had 6 that went through there and 144 that went through on the offer over here. So we're seeing our seller come back in, and they're being pretty aggressive. Now, if you see where my cursor is, I'm highlighting it over the offer on a price of 5 here. Also, I'm taking into account at this moment that 675 is a reclaim, and I did miss that reclaim the first time we went down there. So back on target here, you can see my cursor is highlighting over 5 on the offer, and I'm watching both DOMs at the same time. And I guess this is kind of a tricky skill, right? Because, you know, obviously watching one DOM is hard enough, but watching 2, I guess, is the next level. And that's why I keep them right next to each other, right in my cone of vision, where I can basically read both of them at the same time. And again, I'm not an expert at it yet, but I've gotten a lot better at reading them both together. But basically, I want to keep them as close together as possible. All right. So 12's printed on the offer, completed 11.5, and I'll keep watching this here. Let's keep watching. 11.5s are still completed. And then we go printed on the offer at 11.5. Now that's when it starts to get interesting. And you can see that the market is still continuing to move down. They hit the bid at 475 and went offered, and we're trading at the next price. So I think for me at this moment, that's enough information. Like, we're going offered at 11.5 there. And let's see if I execute it at this moment. So I see it went offered. I put the offer in. As soon as I saw that, or basically maybe about a second or two after that, I put the offer in and I got short at 475. All right. So now we can look at this trade and we can look at the stop here. This stop has been placed automatically by my system, which is giving me a measurement of the volatility, which is based on the current price movement of the last couple of bars. It's not only accounting for recent data, it's accounting a little bit of cumulative data as well. But again, it's just a reference, and it just kind of places my stop a reference away. It doesn't necessarily mean that I'm risking that many ticks. I'm not actually risking 9 ticks on this trade, because with a momentum aggressive entry like this, most probably what I want to be doing here is, in the case that the trade goes in this case, and then for whatever reason we see, I don't know, a lot of them hit the bid and they just keep rebidding 11.5 to 12. It's going to be a little bit questionable at that point, and I'm going to probably want to be working on for at least a couple of tick loss. So in the case that the trade reversed on me immediately and I didn't get anything good in this case, I'm going to be most probably trying to work out for a small loss rather than sitting in it, watching the market kind of go back and forth above against me, basically. So for this type of entry, again, it's relevant to the type of entry you're taking. An aggressive entry like this, management is a little bit more aggressive because you need the market to kind of move in your favor. In situations, and I'm going to show you a trade after this where I wouldn't manage the trade like this because of the execution of the trade is a different kind of execution. But for this one, I did. So we'll keep watching it. And you're going to see some noise here. Now, this stuff happens all the time. The market is designed to do this. So you see they hit the bid at 11. They're offered 11.5. Now watch the 10-year primarily, because the level that I'm trading off is primarily there. So some back and forth here. They're hitting the bids at 11. And watch, we're going to see a bit of noise. And it's going offered at 11s. It's pretty good so far. And then it goes back bid. And again, if you're trying to trade every little tick and every little sweep of the bid and offer, you're actually going to get swept out. Like this would have swept you out right there. If you're just overly analyzing the order flow and overly analyzing the bid and offer movement, you're absolutely going to get shithoused trading this type of entry. It's very important that you understand how to zoom out a bit and understand the bigger picture of these levels. And for example, if you're a bigger player, you're not just going to come in and sweep the entire order book. You need the market to kind of show more hands, right? So if you're the institutional trader that needs to be putting on their hedge if the market's breaching this area, well, what I'm going to do is I'm not just going to sweep the whole book. I'm going to wait for traders to try and bid. Or what I do is I might slam the price up a couple ticks. I might hit a couple offers or pull a couple of my offers out and bid it up a bit. And then all of a sudden I'll pull my bids and let some of the smaller bids accumulate. And then I'll go ahead and take all those bids, and then the market can fall afterwards. That way I get my price improvement, and then I can cover that lower if it's a short or just a scalp. Basically, as an institution, you want to improve your pricing as much as possible or get efficient prices on your trade. So let's keep going. I know I go on a bit of tangents. So we had that little snap up to 12s. And again, it slaps up to 12s again, trading on the offer at 12s. All on the offer. So far, no big red flags here. You know, we're a couple ticks against us. Trading on the offer, then it goes reoffered. And so far, the trade is still okay at this point. What I don't want to see is it going bid at 12, trading 12.5, cleaning out that entire offer potentially, and then backticking 12 to 11.5, and you're only seeing like a couple contracts go through and it's like barely trading anything, and they're taking pretty much all the offer that's there. That's a bit of a bad sign at that moment, because what I want to see is I want to see them get stuck here, and any bids that pull up, I want to see them get hit, and I want to see the offer continue reloading like that. And that's kind of what we saw right there. The offer continued to reload. Now we're offered over at 11.5, and then they slam it down, and at this moment you can see they slammed it down in the 5-year, and it really fell like 4 or 5 ticks in that moment. I didn't get filled on that limit that I had sitting there, and I'm being patient with this at this moment because the trade is still good. I have my target, in this case, a measured move away, because I'm only trading a 1 lot, and we can talk about that because it is important. A measured move in this case, you know, my volatility is saying 8 ticks or 8-9 ticks, but, you know, I kind of go with what I think it's offering, and I think there was a level down at 9.5 to 9 at this moment. So what I was actually looking for is a target to be filled down here, and you can see I was filled in that instant. I was looking to be filled as the 10-year stopped down to about 9.5 to 9s, because there was another level of context there down at 9.5 to 9, and I'll show you that. It was basically this right here. So this type of zone is basically where I was looking to start to get paid on the trade. Like as the 10-year slamming down to 9.5, 9, if the 5-year is not slamming down, like that's a bit of a red flag. In this case, it did slam down. And I did get paid on that limit. So I do leave limits sitting around areas where my profit targets basically are. So I'll talk briefly about trading a 1 lots, 2 lots, etc. So in higher volatility, based on my risk tolerance and account size right now for this product that I'm trading, which is the 5-year treasury. Again, the chart here is for the 10-year, but the one I was trading is the 5-year. 1 lot trading is basically the sweet spot for me. 2 with this volatility is pretty extreme, because my loss limit would be about a 14 tick loss limit based on my percentage of the account that I have configured and the account size. So if we're 8 tick volatility like this, and you know, potentially you get stopped out, you know, we potentially have 2, maybe 3 maximum full stop outs before it's game over, right? So for me, 1 lot is basically all I can work with, you know, and just trade those 1 lots and trade it for cash flow more than anything. And also trading 1 lots is a skill too. It basically teaches you how to learn how to cash flow trades and potentially manage by hand, which is a good skill to have even if you're trading multiple contracts, okay? So that was that trade. Here's the next trade at this moment. So what we saw, and we'll go over to the chart, and I'll try to not be too hindsight oriented, but the chart for the 5-year, we would have basically been on this bar right here. And there really wasn't much context above that or below it. All we had was this reclaim down at 675, which we hit on the upside. And on the 10-year, again, there was no context that was really relevant to any of this in this moment. So this next trade here was a range play. And I was playing on a pullback on the short side, basically, after this big, I guess, outsized move up of this reclaim of 675 on the 5-year. At least that's how I categorized it. So 675, area of context for me. And we went for this big outsized move, and then the market came back down. All this area, well, considering that we had the reclaim and it failed, it could be argued that all this was kind of a stop run. So what I'm doing in this case is I'm getting in front of that stop run. There was something that I remember being at 8.25, and for whatever reason I identified a reclaim up at 8.25. And in this case, what I was playing off of is a move up, like a pullback to the upside, and my stop was going to be behind 8.25 in this case, because I knew that if it were to reclaim 8.25, I would be absolutely wrong. But at the same time, I didn't put my stop right at 8.25, because there's a chance that it can top tick it and then completely reverse, because I've seen that happen a number of times. It top ticks or bottom ticks right on that reclaim price, complete auction right to that price, and that marks the reversal. So I'm careful of those types of things as well. So you can see here, as soon as I placed my sell order in at 7.25, I moved the stop and I was contemplating how far it needed to be. So I settled with 875 in that case, which is just 2 ticks above the reclaim. And you can see here the market is pretty much slamming up after trading at 550 for quite some time now. I guess it's important to include the prior context, because what the market did was, again, we had this big stop run, and then for a few minutes, it's just sitting here accumulating a bunch of size at 550 and at 13.5 on the 10-year. So the market's continuing to chop there at 550. And let's actually listen to my recording, potentially up here. You see we have 6.75s as a reclaim, and it would be everything up until basically 8.25. Now we could allow for a top tick of 8.25, potentially. The only danger with this is that we are going to still be above that daily zone. So we'll see what it does here. So we haven't made it back to 12s yet. I'm thinking potentially this is decent for a pullback. You can see here we're trading here at 5.5s. I'm thinking it could top tick 8s. If I do place an order here at 7s, you can see here that it would basically put my order up there at 8.5s. So this is the live recording of my audio. 8.25 is basically if I put it 2 ticks higher. So let's say 7.5s on the upside here. Let's see. We're going up to test this exposure block. Let's see if I do get a fill here. On the upper end of this, 8.25. I'm not looking for it to reclaim 8.25. I put my stop 2 ticks above it. If it does get there, we'll have to see. So we are short now. We're short 1. And I don't know if it's going to get all the way back to where it was just there at 5.5s, personally. So we'll have to play this as it goes. So maybe that, you see there's a big buyer over there at 5.75, so I might just join them. Yep. So again, one lot trading, right? That's the management kind of with one lot trading. Like I said, I don't know if it's going to come all the way back to 5.5s, because there could be some traders that got trapped there. And again, there's a chance that it just kind of undershoots the area and you get sort of that like market maker trade. The market maker that was holding it up there all of a sudden is willing to hold it up a little higher for whatever reason. So I've had that happen to me before, where I'm looking for a price and then it undershoots me, and then you get stuck chasing it, and then all of a sudden you end up with break even or nothing on the trade. So I'm not really being greedy with this. As you know, we had a decent entry and they offered it over like that. Basically the bids kind of disappeared. If you want to watch that very briefly, we'll watch the fill again as it happened. And I'm pretty much watching the 5-year at this point, the price action of the 5-year as it's slamming up into that 7 area. So I'm filled on that, very small amounts of contracts that trade up there. And, the DOM at this point is not going to be your most reliable thing. You can see that it offers over. That's a good sign. And we're hitting the bid at 675 and it's offering over, which is good. That's basically what the DOM is telling me is that. And then the rest of these bids over here just disappear into thin air. You have 64 and then 20 that go through, then 4 at 6s. So it's basically disappeared into thin air. And then you have this big buyer over here sitting at 575, where 39% of the orders are above the average order size out of all these entire orders combined. So it tells me that there's an institutional buyer sitting here. So I'm going to join the institutional buyer, because I don't know if he's going to be the one that holds the market there. I don't know how much he actually has to buy. He might have 3,000 to buy. So I'm not going to gamble on that with my one lot. I'm just going to get paid. That's the way I see things. In this case, what ends up happening is we'll see what happens. So you have that really weak bid there. Couple pull 860 and they slam it down. Some trader takes the entire thing and it slams down 2 ticks. So that's the type of thing, like, I didn't know that would happen. Like, so there's limits to what you can know and what you can't know, obviously, and you kind of have to know where you're playing in. So like I just finished telling you guys, I had no idea what was going to happen as it comes back into this area. It might undershoot it, might overshoot it, but I'm not going to gamble with that. What I'm going to do is try to get paid on the trade for my measured move in this case. So that's how that trade played out. All right, we're going to go over the last trade here from the Fed that I actually missed. I actually missed this trade, but it was another sort of momentum-based entry that I was keeping an eye on what the 2-year was doing, because there was a big reclaim on the 2-year that I needed to be paying attention to hit the, or take the offer on the 5-year. I was not quick enough and I didn't react to the signal fast enough. But I'll show you how fast the trade played out, and we'll go over that right now. So basically, since the trade I just showed you guys, I didn't really do anything. I was just sitting there watching. And one thing that I'm trying to get better at in my trading is, keeping my foot on the gas pedal when I can clearly see that I'm reading the market well and that there's enough volatility to be trading. Because, even if I were to have a losing trade, there should be no fear of having a losing trade, because it's going to be data that I'm gonna use to improve my trading anyways in the future. So I don't think it's logical to have fear of a loss, especially during sessions of high volatility, as long as I'm seeing things correctly and I'm executing my plans, as I planned them, and not executing trades that I didn't plan, obviously. I'll be honest with you guys, I didn't see any other trades after this. I was very calm and watching and just, keeping an eye on what was going on. And the action was just a little bit weird going into 2:30. It looked like a bit of a whipsaw show here. And then we slammed up and then slammed down, and really not much for me here personally. I didn't really see anything that I wanted to execute upon. And then we have this new trading range that's forming up here, and we try to test those 1375s. Now 1375s was a reclaim on the 5-year, and the same price would have been, I think it was 24.5s, which is not the same price, but that's where the reclaim was there. On the 2-year, it was basically this one, which was 103 and 1/8. That was this level right here that we slammed up to it. And I'm just going back to the other chart. I'm just showing you that there was a reclaim there, an area there. Going back to this chart here, you can see this is the chart for the 2-year in the corner of my screen. And we did hit up to there and then came all the way back down. And now we're in a new trading range. So what you'll see here is that the market didn't actually go back to test that, and then we're going to have a new sort of trading range that forms. The similar reclaim on the 5-year was this one right here, 1375, right there. And again, ignore everything that happened here. Right now, we probably are on this bar right here where we would have top ticked 1375. We're back in this trading range right here where we top ticked 1375. The market came down, and now we are moving back up slowly to that area. So we're moving slowly up into these areas on the 2-year and the 5-year at the same time. Let's watch the price action now. And I guess for anyone wondering, this is kind of what goes into my trading. There's a lot that kind of goes into it. I'm paying attention to different important zones on the 10-year, 5-year, 2-year, and on the 30-year all at the same time. And, I've gotten much better at doing this over practicing it and really getting good at understanding the context and watching the market unfold around these areas too. The levels themselves are not going to be enough. You want to get a feel for how the market trades around those areas. And that kind of gives you the clues about how to be executing things. So you can see I'm kind of running my cursor around the screen. I was planning something, I was looking at something, and then I see the market slamming up like that. And the reclaim, again, just to remind you, is at 1/8 or 103 and 1/8 basically. And it's going to be right around 1350 to 1375 on the 10-year. You can see right now we're trading here at 1175 to 12s. And my ranges here, my volatility ranges are printing the top of the range here starting right around 1350. Liquidity is pretty low here, right about 100 per price. So we slam up, and I want you to pay attention to a couple of things. Right now I'm looking here at the 5-year, and we're going to watch this as it plays out. What I was cluing on for this is the 2-year, that zone on the 2-year. I'm going to make you hear the audio of me talking during this moment. 24.5s on the 10-year. We have a reclaim at 12, 2 ticks higher here on the 2-year. If the 2-year hits this reclaim, if the 2-year hits that reclaim, it could go up. If it hits it and fails, that could be interesting. Yeah, so that's what I'm looking for basically. So that 12.5 area as well as that 1350, 75, that's going to be the area to be watching on the 5-year as the 2-year is trading up to that price. I'm looking at that and I want to see, is it going to go up there and top tick it? Because if it top ticks it and completes up there and reverses, that's going to set up a short trade. And if it goes up there and it starts hitting the bid and trading a bit higher, that's going to set up a long trade, basically a breakout trade, which is going to mean revert, has the potential to mean revert through those 15s on the 5-year.
So we'll keep an eye on what the 2-year does.
Yeah, so let's watch this play out now. It's only a couple ticks higher at this point. Yeah, so we saw a buyer come in, hit the offer, it slammed up a couple ticks.
Paying attention to it.
We have some pretty sizable bids here holding the market up, which is interesting, and everything else is thin, which is weird, but that's the way it looks at this moment. You'd pretty much buy it at 13.70. You'd buy it at 13.5, 13.75. That's kind of where you'd buy it. So I'm planning the trade at this moment. It comes down here and trades these 10, hasn't traded 10 quarters. We're still watching it, we're scouting it. And again, I wouldn't put a buy stop up there because of the risk that it does complete it and reverse completely. That's the reason why I didn't want to have a buy stop there, because it is really risky to have a buy stop there.
Trying to slam up.
Because it's one of those moments where one thing or the other thing happens. If one thing doesn't happen, the other is a lot more likely to happen. And if one thing happens, then it's going to continue.
I want to see what it does at this price here.
So we'll watch what it does. So watch now here on the 2-year. I want to see what it trades. I want to see what it trades at 1/8 basically.
On the 2-year.
Okay, so we'll watch how it trades there. And we'll watch for any completes. There you go. Completed 22 contracts. You saw that? So 22 go through in the offer. That's all. All right. Now what? 5 go through at the next, and then a couple go through on the bid at 12.5. Okay, we're not complete at 12.5. So in this moment, we're not complete at 12.5. The trade is signaling along still. If we were complete at 12.5 and slammed back down, that is no good for the long. But if we are not complete at 12.5 and we trade at the next one, then that sets up some momentum for the long side. And again, listen to me talk.
Trade some on the bid.
I was a little too slow to react. So, and there you go.
Trade some on the bid. I think we're buying this.
You're a little late there, buddy. But there you go, right? The fact that I missed that trade and I wanted to look back at that trade to see if I could have executed it any better. And actually I could have, because if you look, as soon as 12.5 was not complete, basically as soon as it traded on the bid at 12.5, there was opportunity to take the offer at 13.5 here and at 13.75 on the 5-year. So look, right there, it's not complete at this moment. There's still an offer there at 13.5. You could have took them all. There's a couple second window here, and we'll just watch it. There was about 3 seconds of a window that you could have took the offer at 13.5 and at 13.75. If you didn't catch it in that window, it was gone. So right there, this is the window right there. And then they take it, it goes bid 85, it goes bid 200, and it's gone after that. It's gone at 13.75, it's bid, it doesn't even look back. Forget it. And then it slams up 4 more ticks. So obviously the slam up 4 more ticks part, that part I don't know, right? That's the part that you don't know what's gonna happen, because you don't know how fast it's gonna get to the next zone. Sometimes it could come back, chop, and then bottom tick the price and complete it. And then as soon as it trades there, it slams up 3 more ticks. Very efficient market-like, and I can show you an example of that if you guys want. That happened today, actually, on the 15th, December 15th. But in this case, that was that trade, and looking back at it, I definitely could have been faster to execute that. But I planned it, missed it, and now was that trade I missed on Wednesday. And I think that's going to cut it for this video, guys. I could show you some trades on Thursday here. We had a couple of nice ones too, but I think we're going to cut it. If you guys enjoyed this content, let me know down below. Leave your comments and all that. Thank you for watching. Take care.